Welcome to Talk Tickers, your professional deep dive into earnings calls. We're here to cut through the noise, get straight to the crucial insights.
That's the plan.
Today, we're peeling back the layers on Rocky Mountain Chocolate Factory, RMCF, their fiscal first quarter 2026 results. And on the surface, some numbers might look one way, but if you dig a bit deeper, well, management is calling this a truly significant shift.
Yeah, they're making it pretty clear they see this as a pivot point.
A transition, maybe, from rebuilding, which they've been talking about for a while, to actual execution. Is this the turning point?
Well, it's compelling, isn't it, how clearly they're signaling it? And it's not just talk. Some of the numbers are starting to show it, which is, exactly what you want to see.
Okay, so let's unpack those headline numbers first. Then we can dive into the strategy behind them.
Sounds good.
Total revenue for the quarter, $6.4 million. Essentially flat compared to last year.
Right, flat top line.
But here's where it gets interesting, I think. Product sales actually decreased, down to $4.7 million from $5.3 million.
Yeah, and normally you'd look at that and think, red flag.
Exactly. But for RMCF, this quarter, it seems to signal something else entirely, doesn't it? Something more strategic.
It really does. This wasn't a failure to sell stuff. It was a deliberate choice they made.
Okay.
RMCF decided not to renew a contract with a large specialty market customer. That customer represented about $500,000 in sales.
Wow. Okay. Why?
Because that business, that transaction, it was actually unprofitable for them. So think of it like pruning a tree, right? You cut off the branches that aren't producing so the healthy ones can get stronger.
Okay, makes sense. Prioritizing profit over just sheer volume.
Exactly. It's a strategic pivot. It's about profitable growth, not just any growth. That often separates companies that make it from those that just struggle along.
That is a bold move, though, sacrificing top-line revenue for that bottom-line health.
It is. Takes discipline.
Okay, on a much brighter note then, franchise and royalty fees saw a big increase, jumped to $1.7 million from $1.1 million. What's driving that?
Well, that's largely down to higher same-store sales in the quarter. So improvement within their existing franchise base. Yeah, and plus they successfully collected some outstanding amounts, some money they were owed. So that helped boost the number too. It points towards, a healthier, maybe more compliant franchise network.
In the gross profit, that really tells a story about this operational shift, doesn't it? It went from negative $0.3 million last year to positive $0.3 million this quarter.
That's a $600,000 swing. It's significant.
Almost like flipping a switch.
Well, yeah. And this improvement, it was primarily driven by those strategic pricing adjustments they've been making.
Okay.
And importantly, actual operational efficiencies, getting better at making the chocolate, essentially. It's a pretty strong indicator that their efforts to fix the profitability are starting to gain traction.
Costs and expenses were also down quite a bit. $6.5 million this quarter, down from $8 million. That's a noticeable reduction.
Indeed. And that decrease came mainly from lower G&A costs, general and administrative.
Right.
And just other operating efficiencies across the board. It sounds like they're, finally tightening the belt and watching the spending more carefully.
So what does all this mean for the bottom line then? The net loss. It shrank quite a bit, down to $0.3 million or negative 4 cents per share.
Yeah, compared to a much bigger loss of $1.7 million or negative 26 cents per share last year. Big improvement.
But you mentioned something else, the EBITDA.
Ah, yes. Now, this is where it gets really interesting. And it's a critical indicator, I think, that the strategy is actually working.
Okay.
They reported positive EBITDA of $2.0 million this quarter. Compare that to negative $1.4 million last year.
Wow.
This is RMCF's first positive EBITDA result in several years.
First positive EBITDA in years. That is a milestone.
It really signals a fundamental turnaround in their operational profitability, especially, for a company this size in the confectionery market. It's a big deal. Okay.
Huge milestone. Just quickly on the balance sheet, cash was $0.9 million at the end of May, down from $7 million previously, and debt outstanding was about $6 million, pretty much flat.
Right. So cash is lower, debt is stable.
So, okay, the numbers are definitely painting a picture of change, but what's the story behind it all? What's management actually saying now that they're, shifting gears?
Well, the CEO put it very directly, quote, "We're no longer in a rebuilding mode. We're now in an execution mode."
Execution mode, okay.
Yeah, and that signals a real shift in how they operate. More precision, more accountability, more clarity. They're saying that the foundational work they did over the last, say, 15 months, Things like streamlining operations, rebuilding trust of franchisees.
Right.
That's now starting to pay off in the results you see today. And they also emphasize that the financial potential they see, well, it's still very early days in terms of realizing it.
So the focus for this fiscal year, fiscal 26, is crystal clear then. Generate profit and get back to growth.
That's the message. Profit and growth.
Okay, let's move into the operational side, the nitty-gritty. Supply chain. They made a change with freight charges, right? They waived them in Q1.
Yeah, they did that to drive volume, get product moving, ensure freshness.
But now, starting June 1st, they moved to a flat monthly fee program. What's the thinking then?
Well, this new flat fee program, it's actually pretty clever. It's designed to encourage franchisees to place smaller, more frequent orders, ideally like every 2 weeks.
Ah, okay, so not just big bulk orders less often.
Exactly. And the benefit is you get much better product freshness for the customer, which, for a chocolate company, that's absolutely critical. It's about optimizing the supply chain for quality and consistency.
Makes sense. They also mentioned price adjustments, March and again in June, and they're keeping an eye on input costs.
That's right. The goal is clearly hitting those target gross margins, and importantly, with their new systems in place.
The ERP and POSOS.
Yes. Dynamic pricing is actually possible now for the first time, really. They can adjust prices more strategically.
Okay.
So they expect margins to keep improving through, well, a mix of things. These pricing actions, cost cuts, and just getting more efficient in the factory. The challenge now is really using these new tools effectively.
And maybe that's where new leadership comes in. They hire Luis Burgos as VP of Operations. What's his background? Why is he significant?
Well, Luis Burgos brings a lot of experience. Six Sigma, lean manufacturing, continuous improvement certifications. He's got the credentials.
Sounds like the right skill set.
Management seems to think so. They believe he's the most qualified VP of ops the company's had. His expertise is really crucial for driving that operational efficiency and discipline they're aiming for.
Okay. And you mentioned the systems, the ERP, Enterprise Resource Planning.
Right. Integrates core business processes.
And the new POSO is a point of sale operating system.
Yeah.
Both are implemented now.
Yep, both in place. The POS system is already rolled out to over 100 stores. The goal is 100% compliance, get everyone on it.
So what are the real benefits here? How do these systems fundamentally change things for RMCF?
Visibility. That's the key word. These tools give them, really for the first time, unprecedented visibility into what's happening, both at the corporate level and, crucially, within the franchise operations.
So seeing exactly what's selling, where, when.
Exactly. This data, it's not just numbers on a page. It fundamentally helps them make better decisions. Production planning, pricing strategies, marketing campaigns, all of it. They can now do what they call microscopic analytics right down at the store level. That was just impossible before. It's like turning the lights on in a dark room.
So it's not just tracking sales, it's about using that data for coaching. How does that work?
Right. They can now give franchisees much better analysis on their store's performance, what products are moving, how their merchandising looks.
Compared to others.
Exactly. They can coach the stores that are maybe underperforming by showing them the data, comparing them to the best-in-class stores, or just their peers. It's not based on gut feeling anymore. It's factual data.
That must be powerful.
It is. And it extends to pricing, too. They can now show a franchisee, look, here's the range of prices people are charging for this specific item across the entire system.
Ah, so they can encourage experimentation.
Precisely. Challenge them to maybe try a higher price point, see if they can optimize profitability without, killing demand. It's a powerful new lever they didn't have before.
Okay, let's shift gears a bit. Strategic growth, franchise development. They opened a new store in Charleston, South Carolina, first one with the new look.
That's right. Refreshed brand identity, modern layout, and there's another premier location coming soon in downtown Chicago. They're aiming for a pre-holiday opening for that one.
But it sounds like it's not just about opening stores anywhere. They're being more selective now.
Oh, absolutely.
Yeah.
The emphasis is clearly on quality over quantity now.
Right.
Their commitment, they say, is to expand with the right partners in the right locations.
What does that mean in practice?
It means they're actively looking for franchisees who are well-capitalized, financially savvy, entrepreneurial, and ideally have previous franchising experience.
So a higher bar for entry.
Definitely. It means they might open fewer stores, maybe, in the short term, but each new location should have a much better chance of success and actually contribute meaningfully to the bottom line.
And they mentioned an internal goal, improving the ratio of stores per owner. It's currently 1.34.
Yeah, and the largest multi-unit owner only has 4 locations. That definitely signals a move away from maybe past practices where maybe they had lots of single-store owners.
Trying to build bigger, more invested operators.
That seems to be the idea. Build a stronger, more committed franchisee base. And to support that, they've launched a new initiative. They've hired 5 business consultants.
Okay.
These consultants will do semi-annual on-site visits with franchisees, provide insights on product mix, merchandising, help with annual business plan reviews, stuff that apparently wasn't happening routinely before.
That sounds like a much more hands-on partnership approach, more support.
Exactly. A more invested relationship.
Okay, so beyond operations and store growth, there's also this big brand refresh and digital transformation going on. New packaging, updated stores, new e-commerce site.
Yeah, and what's compelling is how systematic it seems.
Yeah.
The signage updates are rolling out. They mentioned the Durango and Corpus Christi Company stores. New consumer packaging for the classic boxed chocolates, but also grab-and-go stuff that's shipping out this month. And you'll see it soon on the refresh website, rmcf.com. It really feels like a top-to-bottom rethink of their brand presence.
And the e-commerce relaunch, they're calling it a complete departure. Sounds dramatic.
Well, they're promising a much more modern experience, easier shopping, better conversion rates online, and focusing on premium gifting opportunities.
So tying online and offline together better?
That's a key part of it. They plan to back up the new website with modern social media and marketing efforts. The goal is driving traffic, direct-to-consumer traffic, both to the website and to nearby physical stores, creating one unified experience for the customer, using every channel to get that sale.
Makes sense. Speaking of new channels, new revenue streams, DoorDash, and other delivery platforms, they're planning to make that required.
Wherever feasible. Yes. They see this as a pretty big untapped opportunity.
Really?
Yeah. Improve store revenue, reach new customers who just prefer delivery these days. It's about meeting customers where they are, making the chocolate more accessible. Pretty critical in today's retail world.
And after the POS system is fully rolled out and the website gets traction, they're looking at the loyalty program.
Right. The current one is apparently pretty limited. They see a big opportunity there to create something engaging, something that boosts how often people buy and how much they spend, whether they're in a store or online.
Seems like low-hanging fruit, potentially.
Could be. Boost revenue from people who already like the brand. And one more thing on the website, the refresh site will have a much better, more intuitive section for potential new franchisees.
Consolidating information.
Yeah, it used to be on a separate site. Now it's all integrated, targeting those enthusiastic customers who walk in, love the chocolate, and think, hey, maybe I could own one of these. Streamlining that whole recruitment process.
Okay, brings us to the investor context. There was a question on the call about needing capital, raising money, maybe for expansion.
Yeah, that came up. Management said discussions are ongoing with the board about capital needs.
But no immediate plans.
No immediate plans right now to raise capital, but, it's subject to board review down the line. The interim CEO also mentioned, sort of personally, that he prefers to keep the balance sheet clean, avoid issuing stock that dilutes existing shareholders.
Okay, so suggests a cautious approach, relying on operational cash flow for growth.
Seems like the preference, yes. Discipline again.
And the timing for making the interim CEO permanent. Also an ongoing board discussion.
Also ongoing. No firm timeline given there.
Got it. But overall, the message from management is they feel they're in a much better spot to execute now than they have been in years.
Right. They believe they have the right strategy, the right team, the right infrastructure finally in place to drive sustainable growth and create long-term value. That's the pitch.
Okay. You know what time it is.
Yes. The disclaimer part.
This is our not financial advice segment. Think of these as our maybe outrageous but plausible trade ideas, like an analyst pitching to an investment committee. Remember, this is purely for informational, maybe entertainment purposes.
Certainly not advice. Okay, pitch number 1. Long RMCF. Call it the operational inflection play.
Okay.
The thesis here is simple. Q1 results, the management commentary. It all signals a clear inflection point. They're moving past the struggles, moving into disciplined execution and growth.
The evidence being?
The positive EBITDA, the margin improvement, even after cutting that unprofitable customer.
Yeah.
The G&A discipline, that's tangible stuff. And those new systems, ERP and POS/OS, they aren't just IT upgrades, they're operational weapons now. Real-time data for better decisions on pricing, inventory, coaching franchisees.
Right.
So you have this internal transformation happening. Combine that with the external brand refresh, The smarter approach to new stores focusing on those well-capitalized, sophisticated operators. It suggests a higher quality growth path is opening up.
And the market hasn't caught on yet?
Maybe not fully. The market might not yet appreciate how sustainable these improvements could be. So the stock could re-rate higher as people recognize this isn't just a one-quarter blip.
Okay, interesting. The operational inflection play. What else you got?
Pitch number 2. This one's a pair trade. Long RMCF, short small cap regional confectioner X. Let's call it the modernization arbitrage.
Ooh, okay. Arbitrage? Explain.
The core idea is RMCF's aggressive digital overhaul. That complete departure e-commerce site, the integrated social media, making DoorDash mandatory.
Right.
That represents a significant competitive advantage. It lets RMCF attract new customers, drive sales both online and in-store in ways that smaller, maybe less tech-savvy regional competitors just can't match.
They're stuck in the past, potentially.
Potentially. Or just lack the resources. Meanwhile, RMCF is focusing on disciplined growth with better franchisees, finding that white space across America. They're not just fixing themselves. They're positioning to take market share.
So the arbitrages.
The potential arbitrages between RMCF's operational and digital gains, which might still be undervalued, versus the likely stagnation, digital and operational, of some smaller peers. You capture that difference.
Okay, the modernization arbitrage. 2 interesting takes there.
Remember, not financial advice.
Absolutely not. So let's recap our deep dive into Rocky Mountain Chocolate Factory's fiscal Q1 26. What we're seeing is a pretty powerful pivot, wouldn't you say?
I think so. Those foundational investments they made, they're now turning into actual results, better margins, and critically, that positive EBITDA.
And they seem to be systematically executing operational improvements, smarter franchise partnerships, that whole digital transformation piece.
Right. And management's commitment seems clear. Keep generating profit, keep driving growth through the rest of this fiscal year.
Okay, well, just a final reminder for everyone listening, this deep dive is for informational purposes only. It is definitely not financial advice.
Please do your own research.
We do encourage you, though, to explore what's happening at Rocky Mountain Chocolate Factory. Consider the potential long-term implications of the strategic shift they're undertaking. It leaves you with a question, maybe. Which part of this big pivot, the operational discipline, the digital leap, the franchise focus, which part do you think will ultimately be the most impactful for this iconic brand down the road? Something to think about.